Today is the 15th of August. Let's see what's in store. Right, today I want to talk a bit about the headline inflation it's holding, core rises, what the latest CPI means for the market and the rates. And I think most important is the rates, right? So what was the result that we got? Now the CPI held at 2.7% year over year in July, while core CPI rose to 3.1% from 2.9 the month before, right? Core, for those that are still new, is the inflation that that does not take into account the energy and food calculations, right? Now, the split looks small on paper, but it matters. Headline inflation was kept in check by cheaper energy and some easing in goods price. Now, core inflation excludes food and energy and is driven more by services like shelter and medical care, which move slowly and often keep rising even after goods and fuel cool. Now, in short, the price cuts you notice at the petrol station help headline CPI stay put, while the stickier parts of the economy kept core running hotter. Okay, so this is just to give you an analogy how it's differentiated. Now, this inflation story is still intact, but I wouldn't say it's complete. Now, what does that mean in practice? It means that inflation is easing, but the process is not finished. Headline CPI near the 2 to 3% zone tells the Fed that the worst of the price surge is now behind us. Core at 3.1% reminds them that services, inflation, and housing costs are not yet, right? Not yet when they want them. For now, the market treats it as a temporary blip. Okay. Now, markets choose to focus on the positive side where the stability in headline CPI came as a relief after concerns it might jump higher. And that reassurance pushed expectations for a September cut even higher. Okay. So one thing that we need to focus on, okay, because the Fed definitely be looking into this, is the labor data. Now, the labor data tilted the scales too. The July jobs report was soft with weaker payrolls growth and an unemployment rate that is no longer falling. Now, the Fed's two goals are stable prices and maximum employment. Cooling inflation plus a softer labor market is the classic setup for a first step towards easing. Now, the Fed will not say it is cutting because of one bad job print, but taken together, the recent data give them cover to begin normalizing policy. Now, the point here is this, is that tariff is still not going to go away. You know, this thing that the Fed is thinking that might, push inflation higher, this is not going to go away. And they are seeing signs that it is happening because tariffs are the wild card everyone keep asking about. Their effects rarely show up all at once. Importers often use contracts and hedges, then pass costs through gradually as inventory rolls. Now that creates a slow burn rather than a spike. Some categories will feel it sooner, especially tariff-sensitive goods or inputs used by manufacturers. Now, others will absorb part of the cost through margins. The July CPI did not show a broad tariff surge, which is why markets treated the report as benign. Now, the tariff question is not gone. It is a medium-term upside risk to core goods and some services rather than a done deal. So having said all this, we had looked into the inflation data, we looked into the jobs, we looked into the tariffs, how it's affecting the overall Fed decision making. Now, the key question right now falls into this: is the Fed going to cut it twice or 3 times? Right now, this is the outcome. So what we expect the rates, the most likely outcome is 2 cuts this year. One in September and one in December, assuming inflation doesn't start climbing again and the labor market keeps cooling, right? So this is the outcome. A third cut could happen if economy slows more than expected or if inflation falls faster than anticipated, but the Fed would need stronger evidence that core inflation is on a lasting path towards its target. For investors, the difference between the 2 and 3 cuts is more about the message it sends than the number itself. Now, 2 cuts would gently lower borrowing costs without suggesting the Fed is worried about a major downturn. Okay, so this you have to take note. In that case, the stock market would likely see a steady, moderate rise, led by large, financially strong companies that generate healthy cash flow, right? Interest rates on longer-term bonds would drift down a bit, making it slightly cheaper for businesses and households to borrow. 3 cuts, on the other hand, could trigger a sharper initial rally as investors bet on more liquidity, but the market's leadership would depend on the reason for the extra cut. Now, if the Fed moves because the economy is losing steam but not in recession, defensive sectors and companies that benefit from lower rates, such as utilities and real estate, could lead, with small cap stocks gaining the cheaper financing if credits remain accessible. If the third cut comes in the context of a steady growth and falling inflation, then more economically sensitive sectors like tech, industrials, and consumer discretionary could also perform well. Okay? So in either case, the reason behind the Fed's decision will matter as much as the cuts themselves. But, if the economy is falling, it's losing steam, and there are signs of recession, then yeah, everything will drop as well. But defensive sectors will drop less and probably recover faster. So these are the things that we need to see going forward and understand, and from there we would have a better idea how to deal with the stock market and all the other assets classes, like like the dollar, how do you go and deal with dollar and other risk assets like the cryptocurrencies and so on. So let's see what's the Fed decision and the subsequent actions taken by them. With that, that's a report for today. Thank you.